Hello everyone, this is Ben with IncomeOptionsTrading. In this video I'm going to go over an introduction to futures contracts. Most people start with trading stocks, also known as equities, and maybe some simple option strategies. You might be used to the market opening at 8:30 Central and closing at 3 Central Time. In the evening, maybe you log on to Wall Street Bets or some other trading forum, and you see others saying something like futures are green or futures are red. Well, what are they actually talking about? So in this video, I'm only going to be discussing the most liquid futures products that are available on brokerage platforms. These futures products are provided by the CME Group, which is the Chicago Mercantile Exchange. There are also products from the Smalls Exchange, but they are relatively new, so I won't be touching on those today. I use the Tastyworks platform for my trading. It has full access to futures, stocks, and options trading. If your brokerage doesn't offer future products like Robinhood, then I would recommend trying out Tastyworks. I have my referral link in the video description if you do decide to open an account. And for new customers, there is a crypto promotion going on through the end of September to receive some free crypto for new customers who fund an account. On the left-hand gutter here, I'm going to go to the CME Futures watch list. So I'm going to switch from my custom one here, go to Futures, and then go to Futures CME. If I click on that, you can see the various symbols for the futures products. You can tell that a symbol is a future product if it starts with a forward slash. You might also see futures represented without the forward slash and instead end with an underscore F. I think like Yahoo Finance actually uses an equal sign F at the end. So for ES instead of forward slash ES, it would actually be ES underscore F or ES equals F. Those are a couple different ways that futures are represented. So what exactly is a future? Futures are also called commodities. Those are used interchangeably. Traditionally, futures were created so that both the customers and the producers could lock in a delivery date and a price. Because futures involve a delivery date, they need to have an expiration. So they differ from stocks where there are different futures contracts, each with a different expiration date. So if you look back at the watch list here, you can see that there are both white and gray characters. The white characters symbolize the actual future product. For example, CL is crude oil, NG is natural gas, and GC is gold. And the gray letters or characters are the expiration code. So each month has its own letter. So I will have the what each month code is in the video description if you're curious as to what they are. For example, the U here is for September expiration. And then the gray characters here also have a 1 at the end, and that 1 represents 2021. So next year this will be a 2, and that'll be for 2022. Depending on the product, the expirations may be monthly or quarterly. So we're just going to use crude oil as an example. So if I click on crude oil, which is /CL, and I go to the option chain here, you can see that the option chain shows which futures contract expiration it's using for each options expiration. So you can see that the July 15th option chain is looking at the /CLQ1, which we can see here is the August 21st expiration. The U is September, V is October, X is November, Z is December, and F is January. So we can see that crude oil has monthly expirations for its actual futures contract. Something like /ES is only going to have quarterly expiration. So you can see that it's U all the way through, and then it jumps to Z. So the U is September and the Z is December. So if I go back to crude oil here, one of the biggest hurdles when people start trading futures is having to deal with expiration and delivery. A lot of people are afraid, if I trade futures contracts, what if I forget to close it or do something wrong? Am I going to have to take delivery for these products? So back in the day, if you bought crude oil contract, and if you hold that contract through the expiration date, that meant that you would take delivery for this futures contract. And one crude oil contract is actually 1,000 barrels of crude oil. So I don't know any retail trader who would want to take possession of 1,000 barrels of crude oil. So a lot of traders just are afraid of that, and so they won't trade futures contracts or crude oil because they don't want to end up with all those barrels of oil. Well, in today's world, Tastyworks and most brokerages actually won't let you hold through expiration or let you take delivery. So they'll actually close out of your position automatically, typically before expiration. So you don't have to worry about delivery. So when crude oil, you might have heard last year, I think it was, might have been 2019, but crude oil actually went negative, which most people did not think that was possible. But if you were a retail trader with like Tastyworks, you weren't actually caught in that whole fiasco because Tastyworks would have already closed out your position. So while I have the option chain up here, on the right hand side, Tastyworks actually shows the last price of each corresponding futures contract, which is pretty nice. So for CLQ1, the last price was $74.63, which you can see here. The September, the U is $73.85, and so on and so forth. You can see as we go out in time, the price of crude actually goes down. And sometimes finance will show these prices on a graph, and they'll call that the forward curve. So if you ever hear of the crude oil forward curve for futures, they're just plotting each of these prices on a graph. And if we were to do that, the graph would go down as you go out in time. And when that happens, this forward curve is said to be in backwardation. So backwardation is just a fancy word for the prices further out in time being less than what they are closer to expiration. So if we go to natural gas in this option chain, in this case, you can see that the current month, the August price is 3.675, and there's a little dip here, but as you go out further in time, these values are greater than the closer dated futures contracts. So the curve is actually an upward sloping curve as we go out in time, and that is known as contango. So due to inflation, interest rates, and some other factors, most commodities spend most of their time in contango. And that would make sense for, if you think about any producer of a commodity, because of the unknown, the further out in time you go, those prices are going to be inflated just just because of the unknown. You don't know if there's going to be a drought if you're a soybean farmer or whatever the case may be. So there are actually some traders who will actually trade this forward curve, and they'll do that by buying and selling these different expiration of contracts. So crude oil typically is in contango. Right now it's in backwardation. So there might be traders who sell maybe a September contract and buy a January contract, and they're just playing on the spread where they're hoping that the forward curve goes back more into a contango state, and they profit off of that. But this video, I'm not going to touch on that anymore. I'm trying to keep this pretty basic. You might be looking at this with all these different expirations, and you might have a question of how do I decide which expiration to trade? Well, if you're opening a new trade, if you simply type in whatever you're looking to trade, the brokerage is actually going to bring you to the most active month, or the month with the most liquid, tightest bid ask, and the most volume. So if you're opening a trade, you can just type in /ES or whatever you're trading, and it will automatically pull up whatever the active month is. So you don't have to worry about that too much. And that is good for speculation trades. So meaning if you weren't actually looking for delivery of a product, then you would just go with the active month. If you were a customer of crude oil and you wanted to take delivery, say in January, so you wanted to play the December crude, then you could manually type in /ZLZ1 and click enter, and it'll pull up that contract. But if I go back and I just type in /CL, it'll go back to the active month. Let's say you buy a crude oil futures contract expiring August 21st. As that time, or as that expiration approaches, typically around 7 days before expirations, the active month on the brokerage will switch. So in this case, around August 14th or so, the active month will change from the August contract to the September or the U expiration. At that point, your brokerage will send a notification through email or such, letting you know that your contract is set to expire soon. And at that point, you should do what's called a roll if you want to stay in a position, or you can simply close the position if you want to take your profit or your loss. If you do a roll, what a roll is simply closing your current position and simultaneously opening a new position in the new active month. So Tastyworks actually has this capability built in. So if I go into where I actually have a futures contract, so I'm actually short the /MES, which is the micro E-mini S&P, and I right click, I can roll future, and I can roll from September to December in one click. If your brokerage does not support that, then you'll have to manually go in here. At that point, this will be the Z's, so I can simply just close the position and then open up a new position, and I'll be good for the next 3 months for MES. Or if you're in Crude, you'll have to roll every month because of the monthly expirations. We'll go back to the crude oil future here in the option chain. The next thing I'm going to touch on, probably the most important complexity with futures, has to do with the notional value, the tick size, and the multiplier. So if you're not sure on a particular product, you can go online to the CME group website and you can find all the information you want on a particular product. So if you're not sure, check this out. It gives you the time that it's open, which for futures are typically 23 hours a day, 5 days a week. They typically open 5 p.m. Central Sunday night and close 4 p.m. Central Friday. There's some futures such as the treasuries that have, the agriculture products, which close earlier. I think they close at 1:30 Central. So those time frames are a little bit different, but they're open typically 23 hours a day, 5 days a week. But if you go on that website, you can find all the information you want to on a particular future product, CME future product. So I'm just going to use crude oil as my first example here. So one crude oil contract is right now at $74.63, and this price is a price per barrel, and one futures contract controls 1,000 barrels of crude oil. So someone might look at this not knowing much about futures and think, oh, this is a $75 stock, so I can trade it, but it's actually 1,000 barrels. So if you take 74.63, in this case, that was the last trade, and multiply it by 1,000, this is actually a $75,000 notional product, which is quite large for most retail traders. So it's important to know how much each future contract, the notional value, is worth before you actually start trading. So it's important to know what the multiplier is, or how much notional value each future contract is worth. I mentioned that for crude oil, there's 1,000 barrels per contract, so the multiplier is 1,000. The last part I mentioned about the pricing is knowing the tick size. So what is a tick? You might not have heard that before. Tick is a fancy word for basically the smallest interval that the future contract can move. So crude oil is very similar to stock in that crude oil moves 1 penny at a time. So one tick is 0.01. And because the multiplier I mentioned earlier is 1,000, one tick will move your profit and loss by $10 at a time. So for every 1 penny move, your profit and loss will move by $10. It's also helpful to know how many ticks are in a point. You might ask what a point is. A point is similar to what you would think of as a dollar in stock. It's the first decimal, or the first digit before the decimal. And so in this case, it would be the 4 here. So for crude oil, since it moves in 1 penny increments, and there's 100 pennies in a dollar, there's 100 ticks in a point. And you might also hear the word point sometimes referred to as a handle. So point and handle are the same thing. So let's look at one more example just to make sure we have this concept down. So I'm going to go to the /ES, which is the E-mini S&P 500 futures. The ES is the most liquid and active product in the futures market. So the ES has a tick size of 0.25, meaning that the /ES actually moves in quarter values instead of penny values. So it'll go from 0.00 to 0.25 to 0.5 to 0.75. It'll never trade 0.01, 0.02, similar to that. So for the ES, there's actually 4 ticks per point because there's 4 quarters in a dollar. And the multiplier for /ES is 50. So a 1 point move in ES will actually move your profit and loss by $50 or $12.50 per tick, with 1 tick being basically 1 quarter. So the notional value of ES /ES is actually worth 500 shares of SPY or $218,000, which is too much for most retail traders. There is a micro product for some futures products as well, which are typically 1/10 the size of their mini counterparts. So for the ES, the micro is actually /MES. That's the example I used before. In this case, I'm just going to touch on it quick. The notional value for this one is 21,800, which is 1/10 the size of ES, and the multiplier is 5 instead of 50, and the tick size is the same as the ES, with 1 tick being 1 quarter and 4 ticks in 1 point or 1 handle. I really like the micro products, so I'm going to do another video in the future solely on the micro products and go more in depth on those. There are 2 more items I wanted to touch on for this futures introduction video, and they both relate to the question of why would I trade futures instead of equities. The first reason is the direct exposure to various sectors instead of through stock ETFs or mutual funds. ETFs and mutual funds typically have management fees. So the various sectors include the indices such as the S&P 500, NASDAQ, Dow, and Russell. Currencies such as the Aussie dollar, the euro, Canadian dollar, and the yen. Metals such as gold and silver, which are /GC and /SI. Commodities such as natural gas and crude oil, which I showed earlier. Treasuries such as bonds and notes, which are /ZB and /ZN. There's also agriculture products such as beans and corn, and there's even a CME Bitcoin future, which is pretty cool. This is relatively new. It's 5 coins per contract. And the last topic I wanted to touch on has to relate to span margin. So if you haven't heard of it before, you can do a lot of research online about what span margin is and how it's calculated. But in essence, span margin takes into account all your futures positions and determines what your 1-day risk is, and that is what your buying power reduction. So if we look at one ES contract, which is worth $218,000 notional value, the buying power reduction down here is only about $12,000. And this can be good or really bad depending on the trader. It can be very dangerous if a trader is unaware of the notional value, but it can be very efficient if a trader has a large account but doesn't want to use up too much capital in this position. Maybe the trader just wants to scalp in and out and won't be in the trade for very long. So it can benefit scalpers or quick in and out trades. Another benefit of futures for scalping is that there's no wash sale rule like in equities, and there's no day trade limitations if your account is under $25,000 like for equities. And lastly, futures have the 1256 tax treatment, meaning that profits are taxed at 60% long-term capital gain and 40% short-term. So hopefully this video was helpful for those who are looking to get started using futures in their trading. I haven't touched on too many specifics on products, or I haven't even touched on options on futures, but we'll plan to in the future. If you have further questions or have any comments on what else you'd like me to do a video on, please discuss down below. And thanks for watching.